Hershey Company is a stock that I do own myself. It is down 29% over the last 12 months. It's trading right there towards its 52-week low and currently offers a yield touching 3%. Now we have a mixture signals from analysts with 1 buy and 2 hold ratings. Today's episode, we're doing a deep dive to understand if this is a strong, undervalued buy now, and I'll give you my thoughts as we do go along today. We're going to take a look at their top line revenue growth as well as their bottom line net income. We are going to discuss why this company has been battered. We're going to talk about the cocoa futures and why this seems to be a trend that isn't helping this company moving forwards. We'll also look at this company's health, their total cash versus their total debt, as well as seeing if others in the industry are suffering from the increase in cocoa prices that have affected Hershey's massively over the last few years. We'll also look at their dividend safety. Now their yield is touching 3%. Does this look more and more attractive? Something that you do need to really consider for your own portfolio. And we're going to take a look at both insider ownership as well as institutions to understand what is going on. We'll also touch upon some forward guidance that they are expecting growth 2024 and beyond in their latest presentation. And we'll also talk about Feastables. Is it a company that can take over Hershey, as well as looking at their market share? Don't forget, as always, we will run it through the valuation model, getting to our intrinsic value as well as our acceptable buy price given that investor margin of safety, and look towards Wall Street to see what their upside is for the next 12 months. Hershey is a company that has been battered. As we mentioned, it is down 29% over the last 12 months. Over the last 10 years, however, it is up 91%. We do see its all-time high sitting at $275. In fact, that was about a year ago today, and it is now trading with a forward P below the S&P 500, which sits around 21. It is looking at 19.34. So is this something to really consider if it isn't one you hold, or even, in fact, one that you want to add to if you already hold it within your own portfolio? Now, a large reason for this drop that we did see in May all the way down to its current trading price is for a product that they use to make their chocolate, is cocoa, and as we can see, the futures reflects how expensive this is. In terms of the last 12 months, it is up 270%, so that is a rapid rise. Now, the reason why the increase to the cocoa prices over the last 12 months is an issue for Hershey. In fact, it is one of the ingredients used to make their products and therefore is part of their cost of revenue. So as the cocoa price increases, their cost of revenue increases and therefore their gross profit decreases, which is bad. You want to see an increase in revenue and either a flat or a decrease in cost to revenue with gross profit increasing. Over the last 10 years, then what do we see? Well, we do see their top line increase, $7.4 billion in 2014 to $11.2 billion. And as always, we want to see a minimum of 3 to 7% growth year on year. When we take a look at it, it has been increasing over the longer term, but there are some periods where their top line does decrease, as we can see. But if you are a long-term holder, in terms of their top line, it does look healthy. In terms of their bottom line, well, again, we obviously want to see increases to the net income, $850 million in December 2014, $1.9 billion in 2023. So top line and bottom line are increasing, as we can see. A little bit of some inconsistencies over the longer term. Nonetheless, it is something just to be aware of. As the cocoa prices do increase, that will affect their margins. But right now, we can see over the last few years, though, their bottom line has been increasing as well as their top line. In terms of the health of this company, then their total cash has been pretty much flat over the longer term. But from 2014, it has dropped slightly from $472 million to $402 from their latest quarterly report. We can see very minimal movement over the longer term, although we do see a slight peak in FY 2020. In terms of comparing the $402 million to their total debt numerically and directionally, what we do note is it has in fact doubled from $2.2 billion in 2014 to just under $5.2 billion. So their total cash, whilst it has dropped slightly, their total debt has increased fairly significantly in relation. As we can see here, it is moving upwards, which isn't a massive red flag indicator, but something that is important to understand when we analyze their dividend safety. Now, other companies in the market, we can see packaged food and meats, General Mills, Danone, Kraft Heinz Company, as well as a few well-known others. What we can see now, this includes dividends reinvested. You would be down 27% if you were a holder just over the last 12 months. If you were a holder over the last 5 years, then what you can see here from this graph is that in actual fact you would be up 74%. So they are the leader out of their competitors that we have selected over the last 5 years at 74%. And if you were holding this for the last 10 years, what you can see out of the pick, it would be the leader, up 139%. Now, not a massive growth over a 10-year period, but you can see even with the massive drop that they have had just in that short term, they are still the best out of these. Now, as always, past performance is not an indicator of future performance, so whether or not this is a performance you're happy with, do understand this isn't something that will again happen over the next years. It could be a lot better. In fact, it could be a lot worse. Now, in terms of looking at some of their metrics, so starting off with their growth grade, they get a B-. A few things to pull out from here: year-on-year increase to their top line, 7.16%, a lot better than the sector median, around 3.4%. Forward-looking, around 4.4%, slightly higher than what the sector is looking to see, around 4%. And when we look at the EBITDA growth as well as the EBIT growth year-on-year, we can see they have performed very well when you do consider that the industry itself has had single digits. Now, in terms of looking at their forward EPS, earnings per share, long-term growth, now this is 3 to 5 years, so this is the compounded annual growth. They are getting a fairly poor rating, 6.46%, when you do look at the likes of other companies getting in 8.15%. So overall, it's okay, nothing great, nothing too bad to be warned about, so it does get that B- stamp on their growth. In terms of their profitability, a lot more of what we want to see. An A rating, we can see very strong margins, 45%, with the essential sector coming in at 35%. When we look at their bottom line margin as well, 17 versus 5. So margins, profitabilities overall looking very strong, as we can see some very, very good ratings. As always, if you do want to take a look at these in detail, you can pause the screen and have a quick gander. Now, in terms of looking at how the insider ownership sits, it is 0.29%. We do see around 80 million worth of shares sold over the last 12 months, with around 8 insiders selling. Now, what we can note, you do have to go back quite a fair bit just to see this. In fact, the largest portion of that was Q2 2023. So we are talking about nearly a year ago today. So when we want to take a look at any recent buys or sells, well, in 2024, we can in fact see the CFO, Stephen V, did sell around 1,500 shares. Now, this was just under $300,000. Again, you can make up your own mind whether or not you think this is a bearish signal. But as always, insiders do sell for many reasons, and we can see, in fact, the CAO has also sold, the Chief Accounting Officer, Jennifer M, but a lot less shares, totaling under $90,000. As always, though, do let me know your thoughts below whether or not you do believe this type of insider selling is something that does impact your own investment thesis. Now, when we take a look at institutional ownership, 58%. We see 13.8 billion worth of sales versus 5.3 billion worth of buys. So we can see over the period, institutions, in fact, one of the rare times that we do see are selling more than they are buying, with the largest bulk of this, in fact, being in Q4 2023, a significant amount sold. When we look at the more recent period, we do, however, see the opposite, 61 million buys versus 6.74 sold. So quite interesting to note that over the longer term, yes, institutions have been selling more, but when we look at Q1 of 2024, they have in fact been buying a lot more than selling. Now, one thing that I did want to pull out is when we do take a look at their market share. Now, there is a lot of talk of Mr. Beast Feastables coming in to take some of that market share that Hershey's has had. Now, this is an article. Now, it was essentially statistics from last summer, so July, August 2023. And it talks about the US chocolate brands and how much in terms of the consumers have had these products over the period. Now, what we can know, in fact, 52% of them did say they did have chocolate or candy bars from Hershey's, 50% of them Reese's, which again is from the Hershey company, and then you can have a look at the others. In fact, towards the bottom, we do see Mars, although we see it on 3 different occasions, Twix, Three Musketeers, and Dove chocolate. But again, this just highlights the fact that Hershey's is still a very large company. It is one that does have a large market share. In fact, a statistic from a few years ago did say it had around 35% in this industry. But as always, there will be companies that do come in and try and take some of that market share. We have seen the likes of Mars and Nestle try this over the longer period. We now have Feastables, a chocolate bar from a huge YouTuber, Mr. Beast. Very quickly then, we did take a look at some reviews. Now again, this will depend on where you do get those reviews from, Amazon or not. It is very similar from what I've been reading. But we can see a lot of reviews are fairly negative for this product. You do also get some positive reviews. We talk about here very dry taste, and it really does depend on, I guess, your particular taste buds as well. But it is interesting to note that whilst people do believe that Mr. Beast can come and take a lot of market share from Hershey, you do have to understand that Hershey is a company that does also have a lot of resources and has been having a long-standing relationship with the American consumers. Do let me know your thoughts on this though. I know a lot of people will have different thoughts. A lot of people do believe that Mr. Beast can come in and take a lot of market share from Hershey's, but right now the data isn't there just to support that. So let's take a look at what we wanted to point out from their latest investor presentation at the conference on February was essentially their forward guidance. Now, not the greatest in all honesty, but we can understand why the share price has been hammered alongside the increase in cocoa prices. 2 to 3% is what they are looking for in terms of top line growth, so low single digits. They're in fact expecting flat earnings per share growth as well as flat adjusted EPS. So something just to factor in when you are looking at your essential valuation of companies, when you're looking at your own margin of value and intrinsic value as well as your investment thesis. Now, just to let you know as well, we have released our latest free weekly article where we do talk about 10 stocks with a lot of upside. If you want to gain access to any of these, all completely free, click on the pinned comment below and you can start reading straight away. Now, let's dive into some of the metrics. Now, they do have a very safe dividend score, 93. As we said, the yield is pretty much touching 3% and the market cap sits at 38 billion. It is a large cap company. Now, last recession, while they maintained the dividend, they didn't increase it, but they also didn't cut it. They had above average growth, negative, it was 0.1%, pretty much flat. S&P average in that point coming at negative 12. And they also outperformed the S&P, negative 30%, with the S&P coming in at negative 55. One of the reasons I do like this as a dividend growth company, 15% increase just a few months ago, 10% over the last 5 years, and again 10% over the last 20, significantly higher than the 4% we do advocate on the channel. Now, they have been increasing the dividends for the last 14 years, but as well, they have been paying a dividend without a reduction for the last 94. Dividend yield theory then, a lot of viewers will know this, but for those that are new, it states the company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation, but in fact we have a double undervaluation signal with the forward PE 19.1 below the 5-year of 24.3. And we can see it pretty much is bang in line with the consumer staples sector PE at 19.1. Now, as always, we don't look at any of these models in singularity before investing. We will conclude towards the end. Free cash flow payout then, as always, we do focus on that, below 70% for consumer staples. In fact, it's been below that every single year, bar 2014. 2024, even at 65%, does still look healthy and attractive, and I would be surprised if we don't continue to get some very strong dividend growth from the Hershey company. Free cash flow per share, very nice growth as well, 213, as we can see, nearly 4 times growth over the last 10 years, expected to increase again to 847 in FY24, so we can see there is still growth expected even though their top line is expected to increase by single low digits. Sales growth then 3 to 7%, as we can see. The last 3 years have been probably their best years. Whilst they are expecting lower in FY24, we can see over the last 10 years they have struggled at some patches through the period. So understand with this company, it isn't a massive company that is going to be increasing their top line double digits every single year. It is in the more mature stage as their top line growth is starting to slow down, as we noted in FY24 and beyond. Total sales then, as we can see, in another format to what we looked at earlier, and what they also do is return some of that excess cash to investor pockets through their share buybacks. Not a significant amount, but in all honesty, they don't hold a number of massive shares outstanding at 206. ROIC then, as always, we want to see 10% or more to give us faith that management are able to effectively allocate their capital. What we can see is whilst it has been decreasing over the last 6 years, in the mid-20s, still very strong and very attractive to potential shareholders as well as those who already own the company. Operating efficiency, as we can see, the margin has been increasing over the longer term. The same can be said for the free cash flow margin, above 7% for the majority of the last 10 years, 14% looking strong as well for FY23. Now the net debt to EBITDA, the earnings before the interest, tax, depreciation and amortization, what this signals is 1, balance sheet strength, 2, dividend safety. It is below 4 consistently over the last 10 years. And what these numbers indicate are the number of years it would take the company to pay off all of their debt net of cash on hand. 1.49 FY23 expected there or thereabouts in FY24. Balance sheet looks very strong. Dividend safety also, as we saw, a very safe score. So now let's jump into the valuation. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now jumping into the first model, the multiples valuation model, companies in a similar sector and size. We have the average PE multiplied by the EPS of Hershey to give us an intrinsic value, which does show our first signal of undervaluation. But keep in mind, we don't look at any of these models in isolation and will conclude towards the end. We then have the dividend discount model, where we have the growth over the last few years. Very nice. In fact, on average, at double digits at 12.22%. We have tried to be very conservative, 5.5% forward looking, and this does give an intrinsic value, again, second signal of undervaluation. Now the third and final model, we have the discounted cash flow model. Average growth 18%, forward looking we have gone for 10%, as we can see, lower than the average, in line with the analyst target as well. Now discount rate at 8%, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we get our third and final undervaluation signal. Also, don't forget you can grab a copy of this valuation model below, where you can get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio, as well as those on your watch list below. Margin of safety then, with an intrinsic value of $215, we always start off with 10%. Execute on this if it meets the 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. And then we pretty much keep going till it's near the current trading price. Now in today's episode, we see around a 15% MOS level, and that depends on you as an investor, your own investment thesis, whether or not that is sufficient for you to execute on that price. Now, if you were looking for around 20%, you would be expecting around $172. But again, it depends whether or not you believe it will hit that price. With cocoa prices increasing constantly, it could be one that you maybe see in the foreseeable future to execute. Personally, as I mentioned, I do hold this in my portfolio. With a 15% margin of safety and a yield of around 3%, it does look very attractive. And if it does continue to drop over the next few days, this is one that I will continue to add into the portfolio. Now, in terms of Wall Street and their price forecast over the next 12 months, they do see this price hit pretty much our intrinsic value that we've calculated at $214. They see upside of 17%, strong double digits. But as always, let me know your thoughts in the comments below. Is this one you're looking to add? Maybe this is one you're still on the watch list waiting for a lower price, or now it suddenly has a 3% yield. It is looking a lot more attractive. As always, let me know your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button. And as always, we'll see you all on the next one.